Is the annualized income method right for your estimated taxes? If you are a small business owner, you might be wondering how to handle your estimated taxes effectively. One method that could be beneficial is the annualized income method. This approach is particularly useful for those whose income varies throughout the year. Instead of making equal payments based on a steady income, this method allows you to calculate your estimated taxes based on your actual earnings during specific periods. So, how does this work? First, you need to determine your adjusted gross income for each period, which could be quarterly or even monthly. After that, you multiply this income by an annualization factor. This factor helps you estimate what your income would be if the earnings from that period continued for the entire year. The result is your annualized income, which is then used to calculate your estimated tax for that period. This method is especially helpful for businesses with seasonal sales or fluctuating revenue. For example, if you run a retail store that sees a spike in sales during the holiday season, the annualized income method allows you to align your tax payments with your actual cash flow. This means you can potentially lower your payments during slower months and avoid penalties for underpayment. However, there are some requirements to keep in mind. Using the annualized income method is more complex than the traditional method. You will need to maintain detailed income records for each period and file Internal Revenue Service, Form 2210, with your tax return to show that you used this method. It may be wise to consult a tax professional or use specialized tax software to ensure accurate calculations. Who should consider this method? Self-employed individuals, freelancers, and small business owners with unpredictable income often find it advantageous. If you receive large one-time payments, such as royalties or commissions, you might also benefit from this approach. On the flip side, the annualized income method does requiring more record-keeping and calculations, which can be time-consuming. If your income is relatively steady, the traditional method may be simpler and sufficient for your needs. In summary, the annualized income method can be a tailored way for small businesses with fluctuating income to manage estimated taxes more effectively. It helps avoid penalties and improves cash flow by matching tax payments with actual earnings. However, it is essential to weigh the complexity against your income variability before deciding if this method is right for you.